Hello, welcome to the BIS and Yale School of Management webinar. Everyone has been muted on entry of the meeting. If you have any technical issues, please send me a message through the features chat function. Now I will hand the floor over to Stein Claessens from the BIS, who will introduce Professor Metrick. Thank you.
Thank you, Alex. So let me introduce Andrew. He's the Janet Yellen Professor of Finance and Management at Yale School. He's had a long history of teaching at Harvard, at Wharton, and now he's at Yale, where he's been the Deputy Dean as well. Andrew has a great record in terms of publications. It stretches issues of corporate governance and biodiversity, I discovered as well. He's been at Yale since 2008. He took some leave for a year to be at the National Economic Council, where he worked in 2009 to 2010 during the financial crisis. And I think that inspired him quite a bit to work on financial stability issues since he came back to Yale. And he founded the Yale Program for Financial Stability, which has been up and running very actively, particularly, of course, in the last few weeks. And Andrew, in that sense, is really a key expert on financial stability, what countries have done. He's been studying that extensively with his team. So I want to pass over the floor to Andrew. He will give a presentation. There will be a Q&A session at the end, so feel free to use the app. That's probably the most efficient way in Zoom to post your questions. I will moderate those questions after Andrew has spoken, and then we'll have some concluding remarks at the very end. So with that, let me pass it to Andrew, and please go ahead, Andrew. I'm looking very much forward to it.
Thank you very much, Stein. Welcome to everybody. I'm very happy to have the opportunity to talk about economic response to the COVID-19 pandemic. It's been, of course, a whirlwind several months for people in the policy community, not just on the health side, but also on the economic side. My plan today, I have a fairly detailed presentation. Let's see if I can get my screen up so everybody can see it. I have a fairly detailed presentation, but I am not going to go through these 42 slides in great detail. I'm instead going to really focus on the first few slides that give some overall data, and then highlight a few areas that have been areas of focus for governments, and just suggest to everybody that they go and take a look at our website where all of these details will be covered. So what we have here is going to be just an introduction to the stuff that is available and to what we're trying to do with the Yale Program on Financial Stability to be a resource to policymakers during this crisis. Okay, so just briefly an introduction about what it is that we have been doing. The YPFS, as Stein said, was founded in 2013, and in fact, Stein has been a great advisor to us since our founding, one of our founding advisory board members. Thank you for that, Stein. And the flagship initiative that we have, which has been going on for about half the time that we've had the YPFS, is what we call the New Bagehot Project, as in Walter Bagehot. So Walter Bagehot, of course, is famous for his book in 1873, Lombard Street, and for Bagehot's dictum that central banks should lend freely against good collateral at a penalty rate during a crisis. And that's the main piece of advice that the central bankers have had about how to fight crises for about 150 years. You still see Bagehot's picture in the newspaper. I just saw it this week, drawing of Bagehot in the newspaper. And cited by central bankers all over the place. Of course, we learned in the global financial crisis that things are not so simple anymore. And in fact, the types of things that were done by the Bank of England in the 19th century are really only a small part of what governments need to do to respond to financial crises today. And so our main initiative at the YPFS is to try to update that Bagehot's dictum to something that looks more like an overall doctrine plan that you might see from any kind of emergency response institution, public health, for example, or the military into something that's a little more multifaceted. And we've been working on that in a nice, quiet, calm academic way, looking to write about 100 case studies per year, and then build those case studies up into areas such as emergency lending or capital injections, where we could perhaps give some advice and best practices. And we're going about that in a nice, calm way, thinking surely we had a lot of time before we would have another crisis. And while what's going on now is not a financial crisis yet, it is certainly a crisis that is requiring many different plays from the playbook for fighting crises, and may indeed, if we are not lucky, lead to the danger of a financial crisis. So for that reason, we kind of switched over in mid-March to full-time working on response to COVID-19. And that has several elements. I want to just give a little bit of an introduction to those elements here today, with strong encouragement that everybody who is interested in this topic, please visit our website. It's down below. I should mention that these slides, they're not up quite yet, but very, very soon, sometime this morning in the United States, I will have all of these slides posted on our website, along with all the other information that I'm going to be talking about here. And I encourage people to go to it, because the main thing we are hoping to do throughout this crisis is to be a resource for the international policymaking community, who are going to be looking to do all kinds of interventions to rescue and recovery of their economies, and will be wondering, well, what have other countries done, and what has worked and not worked? And we're just trying to be a place where you can go and find that information in the easiest possible way. And so please do visit our website. We have several different things. The first is the Financial Response Tracker, which is just a spreadsheet showing you what's happening in all different parts of the world, the types of interventions, with links to all of the primary documents about those interventions. We also have, we're doing little pieces of analysis on specific interventions and building them up on specific intervention types. These are all on our blog. So we have a financial stability blog, an excellent set of young research associates who are writing several of these a day, talking about either the analysis of specific interventions or sometimes a comparison of those interventions with things that have been done in the past, including during the global financial crisis. All right, so a little bit of the data here. The tracker has, as of 2 days ago, more than 2,000 interventions that have been cataloged around the world. And here we've broken them up into 4 broad categories: emergency liquidity in blue, fiscal policy in red, macroprudential policy in yellow, and monetary policy in green. The traditional things that we have looked at the Yale Program on Financial Stability are the blue and the green. So we did not really look at fiscal policy, except insofar it was used to support financial rescue. We've broadened what we're doing for COVID-19 because it is, of course, this is going to be going on for quite some time, and the fiscal response is a very large component of the prevention and then perhaps treatment of financial crises. But even so, the green and the blue here, which make up 20% of the interventions, we've got over 400 of those traditional type of financial crisis response interventions that you would see from monetary authorities, or either in traditional monetary policy or in emergency lending. The yellow is also quite an interesting category, and one that did not exist in history until now, which is macroprudential policy changes. So what I'm going to do now is just really highlight, give you some statistics about how this has evolved over the last 6 weeks, really, on the policy side, both by type of intervention and and across different countries of the world. And then I'm going to highlight just a few of these areas. You'll see that I'm going to skip through many of these slides. There's many more words on these slides than I would typically have in a presentation. I'm not going to read them all, and I'm not going to bore everybody with those details, but I want people to see the resources that are available to you if you're looking to dive deeply into any of these areas. Okay, so this picture shows just the frequency. This is just a count of the types of interventions globally that we have seen, that we have gotten in our tracker since we started doing this in mid-March. We started in earnest in mid-March. We went and backdated things from the previous 2 months, but we think we were pretty comprehensive early on in the crisis because there wasn't that much going on then on the economic policy side. It's almost certainly the case that we have not captured everything since mid-March. In particular, on the fiscal side, there are many things that have been done that just perhaps did not reach our attention or we did not capture. Same goes for any smaller rule changes on macroprudential policy. But I do think that these pattern is representative of what we've seen throughout the world. And overall, I believe what we will see is 4 different stages, 4 different phases of crisis response here, of which we have seen a lot of response from the first 2 phases so far. All of these phases have a mnemonic where they all start with an R. The first phase is a liquidity run. And you can see the liquidity run in the data, the very, very active, what was going on in the second half of March. And there's a fair amount of green and blue. This is where it was not a traditional panic. It was not based on solvency concerns. It was a liquidity squeeze, and liquidity squeeze was met by the traditional central bank response of lending freely and putting as much liquidity into the markets as they could. And I'll highlight one of those methods after I go through some of these statistics. That was the first phase. We may need lots of green and blue tools again if the liquidity crunch turns into a solvency crisis later on in this pandemic. But you can see that as of early April, there was not as much green and blue, and it was taken over almost exclusively by the red fiscal policy and the yellow of macroprudential policy. That phase 2, I would characterize as rescue. While the fiscal response was often described as stimulus, that's not a very good word for what we've been doing across the globe since early April on the fiscal side. It's much more rescue. It's trying as quickly as possible to get cash into the hands of people and enterprises that need it just to stay afloat. And I will highlight one very important and somewhat novel area of the fiscal rescue, the aid for small and medium enterprises, which I expect to continue. We are now, I think, entering what will be quite a long slog of phase 3, which we can just use the simple R word of recession. So phase 3 will last, I think, almost certainly until we have a vaccine or a very, very efficacious treatment for COVID-19. While there is a lot of attention being paid to the actions taken by governments to enforce social distancing and shutting down of their economies, the recession itself is an endogenous reaction to what's going on with the pandemic. Even if tomorrow all governments were to announce that they were getting rid of all restrictions and encourage everybody to go back to work and go back to their normal activities, it is still the case that a large swath of the population would be significantly restrained in their consumption activities. And just from that, just from people my age and older, unwilling to travel and to go out to crowded public places and spend money, we will have a recession, and that will continue until there is a widely available vaccine or very successful treatment. During that recession phase, the fiscal response will, of course, come greatly to the fore. Monetary policy, while it still has some weapons left, they are limited, and emergency liquidity itself is not the problem. And so many of the tools that we have already seen in the rescue phase for fiscal will really need to be continued over the course of that recession. Most importantly, I would say, and perhaps most difficult for us to handle as a society from a political and societal standpoint, is the need to make sure that the banking system remains solvent. Many of the ways that we have been addressing the rescue phase 2 of the pandemic is to allow debtors some form of relief in their payments to creditors. A lot of that will ultimately fall on the financial system and will need to be absorbed by the financial system. The reason this is very important is that the final phase, which is the recovery phase, phase 4, which I do not believe we can get to in earnest until we have a vaccine or very efficacious treatment. Phase 4 cannot be successful if we have hollowed out our financial system. What is happening now in phase 3 is that many businesses are reaching the very end of their reserves. And before they end up in bankruptcy or in stasis during the recession phase, they will effectively be out of capital of any kind. And they will need the banking system during the recovery phase to be able to provide for them. At that point, we will all have some fatigue on the fiscal side. And seems unlikely to me that we will be able to recapitalize the banking system with the necessary levels if we wait that long. So during phase 3, I think a lot of attention needs to be paid to thinking strategically about how we will make sure that the financial system can survive into phase 4 of recovery. Moving on now to a little bit of data on the responses by country, you can see that this is something that has been spread throughout the world. The country with the most, simple by number of count, interventions is Korea. We also see many places in the developing world that have already started with their response. However, there are over 100 countries that have asked for IMF support. And until that IMF support is forthcoming, the fiscal response, in particular for these countries, is somewhat limited. The next 6 months here are crucial. As we hit wintertime in the Southern Hemisphere, we will need to find ways, the international community will need to find ways to make sure there is some fiscal room in the developing world to handle the economic fallout of the pandemic. Furthermore, we're going to need a way during these next 6 months to coordinate globally on what is going to need to be a transfer during very difficult times from the wealthier countries to the developing countries. So this graph here, I think will be much more, we'll see many more countries with high lines 6 months from now. Okay, this slide says type of responses to be discussed. I'm not going to discuss all of these, but you will see that there are slides on them, and they have been discussed. And for each of these areas, you can click through to a resource guide that we have at the Yale Program on Financial Stability. That will include a spreadsheet that lists in more detail the information about the interventions, and also several specific blog posts on specific interventions done in different countries. I'm only going to highlight three of these areas in the remaining time before I go back to Stein. In about 10 minutes, I'm going to turn it back to Stein so we can have some discussion and Q&A in the second half of this webinar. I'm just now going to talk a little bit about central bank US dollar liquidity swap lines, which is a phase one liquidity run part of the response. I'm going to talk about what I think we've learned and seen so far in SME assistance, which has been, as I mentioned earlier, one of the largest and most important areas of response in phase two for rescue, and will continue to be during the recession phase. And then finally, a brief mention of the large number, the greater than 700 macroprudential policy actions that have been taken since the beginning of this crisis. Really a completely new category for those of us in the crisis management world. So I'm going to skip ahead now without any great detail and just show you that we do have information that is available and what will be posted on market liquidity reactions. In the United States, for example, the Federal Reserve has taken out all of the elements of the broad-based emergency liquidity playbook from the global financial crisis and reinstituted them in a matter of weeks in the United States. Other countries have also brought out their tools from the global financial crisis. You can go to the resource guide on market liquidity programs and see some of those details on our website. Actions by multinational organizations, of course, are just in the beginning phase and will continue. We have our work on this topic we will publish this week, and it of course is work in progress since these are very active areas. What I want to highlight though here now and take a little bit more time on are the central bank US dollar liquidity swap lines and the repo program that has been introduced but not yet used by the Federal Reserve. And I want to highlight this to point out that we've now seen for the second time in a dozen years the great strains that are placed on the dollar-based international liquidity system. And the concern that this raises is that thus far, the Federal Reserve has behaved as an international lender of last resort. But one can see in going and looking at their website and at their Q&A about things, about, for example, the central bank swap lines that have been introduced, that there is some tension here. They feel the need to explain why providing these swap lines to countries that will help the banks and then the businesses in those countries is consistent with the mandate of the Federal Reserve. I think that the reasoning that they've given is sound and they're exactly right, but you can see that it is a challenge, and that now we've seen for the second time in just 12 years the need for an international lender of last resort and the necessity for that to be the Federal Reserve, since there's really no other way. Right now, no other way of this scale. And the scale has been huge. The United States has, with 5 other central banks, permanent swap lines that have been heavily used. We've reintroduced temporary swap lines that have maximum limits between 30 or 60 billion with the 5 countries, the 5 standing lines, Japan, European Union, UK, Switzerland, and Bank of Canada. They are unlimited. There are a variety of questions that need to be asked when setting up these lines. They're currently two-way lines, although it's been the dollar demand that we've seen so far. But the main thing I want to show is just what we've seen so far in the usage of the central bank swap lines, comparing what we saw in the global financial crisis on the left with what we've seen in the first month of COVID-19. You can see that the first month of these two crises were similar. The first month being the first post-Lehman month for the global financial crisis, and the first post-United States deciding to shut down month and introduction of the central bank swap lines for COVID-19. In both cases, we relatively quickly reached $400 billion outstanding. And you can see very clearly that it was the second half of March, which was phase one, the liquidity run part of this crisis, at which point these central bank swap lines have stabilized at about 400 billion. And I would imagine will pop up and down a bit during the recession phase and would be under tremendous pressure if we are unable to make sure that the banking system remains solvent during that recession phase. In addition to the swap lines, interestingly, the Federal Reserve has implemented the FEMA repo facility, as yet unused, which effectively will allow countries that do not have swap lines to be able to engage in repo transactions using their treasuries, their treasury bonds, to be able to engage in repo transactions with the Federal Reserve so that it is not necessary for them to liquidate in any kind of fire sale-like activity their treasuries in the open market. This has thus far not been used. I will personally be watching this number to see whether the liquidity pressures have spread more broadly and are unable to be handled through any of the regional agreements that exist to share some of the dollar's liquidity. Okay, so let me turn next to this area of small, medium enterprise assistance, which has mostly been the expansion of peacetime-like programs that many countries had, trying to scale them up very quickly to handle the panic phase, to handle what was going on in the economy after the shutdown. Much like the health system, there was an infrastructure that was already in place to handle normal levels of need from small and medium enterprises, which of course was not designed to handle the levels that were necessary in the early stages, or let's say in phase 2 of the COVID-19 response. There's a lot of different ways that you can do this assistance. You can hand out money directly. You can have forgivable loans. The government can directly lend or guarantee lending through an intermediary. They can do that in a little more indirect way by providing funding to intermediaries, provided that as long as they pass it along. They can change the rules to allow payment forbearance. Of course, that burden will fall on someone, and make tax policy changes. All of those are methods that have been used in a large number of countries. Grants often being used as a bridge towards those assistance. Already, we have learned some lessons from this. We have seen some things that work and don't work, primarily because in order to get assistance out to businesses as quickly as possible, it is almost certainly necessary to use the banking system, or more broadly, banks and non-bank lenders, to facilitate that. Those remain, in most countries, mostly private industries with an incentive to only engage in transactions that are not harming their own stakeholders. So countries are forced to design these programs, balancing off the needs to have individual companies willing to participate, financial intermediaries willing to participate, and the programs have enough sustainability, political sustainability, by preventing things like fraud and the money going to the wrong places, that they can go on long enough. This is a delicate balancing act. And let me just skip ahead to some examples here of what we have seen. Attempts to utilize the private sector can easily suffer from inadequate incentives. And we've seen this in several places. In Germany, an early incarnation of the program provided 80 to 90% guarantees to the banks. This was rejected ultimately as too low and had to be replaced by a full guarantee to get the program operating at capacity. In the United States, we think about it here, the banks are making a calculation. They have to hang on to a certain amount of the risk, 5% in the United States. And then ultimately, they are receiving an interest rate spread, which is going to compensate them for that risk that they're taking on. and through trial and error, discovered that that interest rate spread of 50 basis points would be too low. So conversations with financial intermediaries are, of course, complicated. They will always be trying to get more, as I would imagine they would think that is their job to do. But we have to detect and figure out what is the number that will get them to participate without it ending up with all of the burden on the government. One challenge of programs that are very generous in order to get the banks to participate is that they will either require that the governments perform due diligence because they have taken the banks off the hook from performing that due diligence, or they will end up handing out money to a lot of places which ex post will be perceived as undeserving. This crisis is likely to last a long time. It is already the case that the press will emphasize the stories where the wrong places or seemingly undeserving places have received funding. Those types of outcomes make these programs difficult to sustain. I should also mention here that there is almost always a strong desire to target the assistance. Target it either to the places that you think are most deserving, or target it to the places that would be marginal, that would be unable to receive credit another way. These things seem to really be very difficult to implement in times where speed is of the essence. In the United Kingdom, a requirement that recipients demonstrate inability to get credit elsewhere was abandoned after it greatly slowed loan approvals. In Italy, a tiered system of guaranteed percentages based on company size was criticized as slowing origination time. And in the United States, the requirement, which was perhaps politically necessary, that assistance primarily be used for payroll, was criticized as ignoring other critical needs. So there really are a lot of challenges in delivering this, and I would leave this topic just by pointing out one other challenge, which is going to be very, very large for us globally in the next 6 months, which is so much of the developing world has their small and medium enterprises that go through the informal economy. So as difficult as it has been in much of the developed world to get these funds into the places that we think are most deserving quickly, places where we do not have bank relationships and we have a very large informal sector are going to be a bigger challenge. And we at the Yale Program in Financial Stability will be watching very closely to see how countries are dealing with this challenge and doing our best to make best practices available to the broader community. I've already taken more time than I told Stein I would take, but let me take 2 more minutes. And I just want to jump ahead to point out what's going on in the world of macroprudential tools. Jumping ahead a handful of slides here. Macroprudential policy, we're defining broadly here as macroprudential policy easing as the temporary relaxation of financial requirements with clear guidance. 56 countries have implemented more than 700 macroprudential policies since late January. I've been telling my PhD students that this is the place where many phenomenal dissertations will be written. We've put most of these policies in place in the last 10 to 15 years. And now we're getting some experience to see what happens when we relax them. They represent more than 40% of the measures in our tracker. And if you go to the link that is on this page, and I understand now that we do have the slides already posted on our website, so if anyone wants to go to them after this talk, they're there, and go through to this link, you will see a kind of detailed discussion of the most common measures that we've seen using capital buffers, easing the approach to non-performing loans, using liquidity buffers, changing the rules that we have on liquidity coverage ratio, for example, and then other measures, including measures with regards to bankruptcy, which will become of more and more importance as the crisis goes on. Let me stop here with my very quick tour and open things up so that we can talk about these things and answer any questions, take any suggestions that people might have. And let me add, for anybody who does go and look at what we have, notices that we have any mistakes or things missing, please let us know. We want it to be right. And if you have any ideas, any criticisms, we'd like to hear those as well.
Well, thank you, Andrew. That was great. Very good. We have been collecting some questions, and I'm going to group them a little bit in some buckets so you can let's see what you can address. You maybe one starting a little bit more from the macro perspective. How does this compare to 2008, 2009? You were there before, of course. And related to that, are there big differences across the world in terms of how one should approach this? Is Europe different than the US? You talked about emerging markets, and we can get into that later too, but kind of does the structure of the financial system matter as well? So two kind of big questions.
Thank you, Stein. Those are both excellent questions. Let me go first on the comparisons to 2008. I think as of course, most people on this call know, that was a crisis that kind of built up, a very kind of traditional financial crisis that built up in the financial system that was preceded by great leverage, and that had a very damaged financial system right at the beginning. This crisis, of course, has a very different early impetus. It may ultimately leave us with a very weakened financial system, but that, of course, is not the case just quite yet. Macroeconomically, of course, we've already seen a very, very bad quarter globally, and I think the IMF projections are that things will get much worse, and I would agree with that. I would expect that the macroeconomic side of this will end up being significantly worse than 2008 and will touch all parts of the globe, and will be the worst thing that we have seen since the Depression. Whether or not that leads us to either a panic phase while we're still having the recession, or to a very weakened financial system that is unable to help us going forward in the recovery phase, that remains unknown, right? And that's something that it's gonna depend on our reaction next 6 months. Now, the second question that you asked was about differences around the world and how to react to the crisis. And I would say the biggest driver right now in the difference in reactions has to do with fiscal room. So countries that have fiscal room are able to go out and replace the huge losses that we've seen in GDP in a way that's sustainable, that really only requires the political will to do it. Countries that lack that fiscal room, I think, have to operate in a completely different way. And there's really very limited amount that can be done by monetary authorities for this type of crisis. Liquidity provision is important. I think that's been done well, but the fiscal response is absolutely crucial. Look, if we take a 20% hit to GDP integrating overall the next 6 quarters, that 20% hit has to come from somewhere. Some of it can be some fraction of the population not eating or eating less, but that's not ideal. And so in places like the United States, in Northern Europe, in Japan, this is largely a political problem of can we use the fiscal room that we have to help those who have been most harmed by the pandemic and by the shutdown. Outside of that, though, we are facing something that could look more like a real humanitarian disaster if there cannot be some form of relief for the rest of the world.
So maybe picking up on that, Andrew, because there were a number of questions for the special case of emerging markets, and in some countries the central bank has been very proactive there, but then the fiscal is not able or willing to step up to it. So how do you see the balance there? I mean, these are very challenging countries, of course, in terms of fiscal space as well.
I I think it is a very large challenge, Stein, and I think that it is really, if this were a epidemic that was striking only the developing world, then it would be clear that it was a humanitarian crisis of very large dimension, and that the fiscal room necessary to fight that crisis would need to be provided to emerging markets through some form of cooperation by developed countries. We need that and will need that in the next 6 months. I know what it's like here in the United States. I imagine it's similar in Europe and in other developed countries, which is people are focused pretty inwards on their own problems right now. And it's not particularly a time where the United States is looking to figure out how they can help the rest of the world. So I am concerned. I think that you cannot replace 20% of GDP integrated over 6 quarters by lowering interest rates or by emergency lending programs. Ultimately, you're going to need to borrow from the broader set of taxpayers, if possible, and future taxpayers, in order to be able to provide relief to people today. So we have that. This is to some degree not my expertise, but as an economist, it's easy to do the math and to see that we will need to do those transfers in some form. And I think that those of us in the community, in the international central banking community, need to make clear central banks can't solve that problem. Central banks can certainly be part of what the recovery phase will be like, but in a recession that has been caused by this type of shock, monetary easing, liquidity provision, emergency lending, they can be helpful, but they cannot replace output that has been prevented.
Thank you. You point out, I think rightly so, there's going to be a lot of stress on the banking systems because of the defaults, SMEs, but not only those, of course, industries from airlines and tourism, etc., are going to be under tremendous strain. So the banking system, as a consequence, is going to take quite a bit of hit. So how do we balance the short run where the hit is coming? At the same time, we still want the banking system to lend to those in need and that can survive. And a specific question in this context that somebody asked was, should we actually restrain banks from paying dividends and engaging in buybacks and do even more than that to make sure that the buffers are there when the recovery comes? Any thoughts on that?
Yeah, so let me go in reverse order there and first talk a bit about the restraints on bank payout, dividends or capital gains. Many countries, and if you go to our site and look at the Macroprudential stuff, many countries have relaxed capital requirements or released the countercyclical buffer where they had one. All very appropriate responses. I would say that's what they're there for. But in particular, the United States and the United Kingdom have not restricted dividend payouts, leaving that up to individual banks. I'll say I unambiguously think that is a mistake. I think that as this crisis goes on, bank capital will be under pressure. And when bank capital is under pressure, it will be mostly a political challenge for countries to recapitalize their banking system. So in some cases, it will be a fiscal challenge, but even in places where it's not a fiscal challenge, where we could do it, it will be very difficult to do politically, given the hangover that we have from what went on in the global financial crisis. So I think it's really a mistake to not today basically require that regulated institutions stop paying out capital. That capital will be needed. And when ultimately we have to recapitalize them, I would hate to see the media dominated by stories about how they paid out dividends only 6 months ago when the crisis was obvious, and to see that preventing the kind of relief that will need at that time for the banking system. In particular, if governments were to say to banks, nobody pays dividends, we prevent the stigma problem of banks prudently deciding on their own not to pay dividends. So the way it's been set up now in the United States, for example, is that if a large bank said, we want to be prudent and not pay dividends, that would be taken by the market as a signal of weakness. And so we have kind of created a bad equilibrium through this particular policy, and I wish we had done it differently. Now, what can we do, and how do we balance, to go to the first part of the question, how do we balance the need to get relief to businesses and individuals, which in part is going to mean some form of forbearance of those loans in some cases, and in some part, encouraging banks to make loans where they might not want to make them, just from a plain old profit maximizing standpoint, with the fact that the banking system ultimately may be a problem. And I think that it's, to go back to our earlier phases, during the relief phase, which we are in now, the rescue and relief phase that we are in now, I think we should be quite happy that in the last 10 years, many strong regulators have forced the banks to be better capitalized than we were going into the previous crisis. We have, it's not universal across every country, but largely the global banking system is far better capitalized than it was 10 years ago. We can thank people like Dan Tarullo in the United States and his colleagues in the international community for being so strong on that over the last decade. With that more heavily capitalized banking system, we have a bit of room to do forbearance and to do relief using the banking system as a conduit. But we must recognize that that is not something that is sustainable forever. We cannot expect 20% of GDP to be replaced off of the capital position of financial intermediaries. So while during phase two, we certainly can be relying somewhat on the banks, during phase three, the recession phase, we will have to be very serious about capital conservation at the banks and positioning ourselves for what could be a very difficult political challenge of recapitalizing the banks or keeping the banks solvent so that they are available to help restart the economy when we actually get to recovery in phase four.
Thank you. There were a bunch of more technical questions about how to measure policies and their effectiveness. So one, you count the number of policies put in place, and sometimes a new policy gets extended. How does one count that? Should one count kind of dollars or euros or some other measure like that? And then, of course, effectiveness. It's early days, but nevertheless, any sense of what works, what doesn't work, you're going to do more work on it, I'm sure. You will be writing those papers, as you mentioned, but maybe some hints of how to do it at least. And a related question, some of these tools are not used. You mentioned the dollar swap, the repo facility. Is that necessarily bad, or should we even think, well, maybe that's all. Once they're there, that's sufficient.
Okay, so thank you. You did a good job of gathering those together, Stein. These are related questions. So in terms of counting policies, we have been counting a policy when it's announced, but not counting it as a new policy if they make changes to it or extend it. I don't think we've seen very many in the way of extensions yet. Those, of course, will come later. So maybe we'll have a policy decision of our own about how to deal with that. But mostly we've just been counting new policies that have been announced. We have considered trying to do it in terms of dollars or euros or percentage to GDP. We have considered that. The challenge there is for things like guarantee programs. They can be very, very large in currency terms, but the out-of-pocket maybe not so large. So for example, in the global financial crisis, the United States guaranteed all transaction accounts at banks, an unlimited way. That effectively was I guess at its peak, something like 50% of GDP. I don't think you really want to count it that way. So there are some programs that are direct, handing out dollars. There are some programs that are backstops And then there are some programs that are just guarantees that are contingent backstops. So it seems to us it is difficult to measure it in terms of dollars in a consistent way. So right now we just have a count of policies. Now, a very important question, maybe the most important question, is how will we know what works? And we, of course, have been facing this question in our previous work, looking at the global financial crisis and previous crises, and it's a very important one. And there, of course, we have, even with the benefit of 10 years of rigorous research coming from central banks and academic institutions, we don't have a whole lot of great evidence that A worked and B worked. So what we have focused on more, and what I think is possible, is while it's hard to know, especially when many programs are being announced at once, it is hard to know what exactly is working and what things contributed, and it's hard to know the counterfactual of what would happen if you didn't do it. It's actually a lot easier to know what didn't work, what did not work, what was a problem. And so the policy that we follow in our own evaluations, and people will see if you look at our longer case studies that analyze interventions from past crises, and that we will be implementing the same thing in our work when we're able to get to more detailed work on the current crisis, is we really will kind of label two things. We have a little bit of color coding. Well, two types of labels. We give something a blue label if we think this is a really cool and innovative idea. We cannot tell for sure if this is what made something work, but we've looked at a lot of these things, and this particular idea of how it was implemented seems novel, and at least anecdotally seem to have a positive effect. So you should consider looking at this. So if you see blue shading, that's what you know it means. Then we have yellow shading. That's a caution flag. Yellow tells you, you might want to be concerned about something like this. And the way we identify yellow is that something was put in place by a country and then they changed it because it wasn't working. An example of that would be using too low of a guarantee for your banks, or requiring a certain type of documentation that isn't available in the informal economy, or imposing certain restrictions on the activities that turn out to be counterproductive for the bank. So when we observe those, when we observe that a policy has been put in place and then over a short period of time later it was changed, an announcement was made, we've made the following change for the following reason, we don't say this was wrong and this was a mistake, because perhaps it's just because circumstances change, but we do provide a little bit of a caution. I don't think we're ever going to get to the point, even with the thousands of interventions that we can analyze from the COVID-19 crisis, where somehow there will be a playbook that people can just look up a page and point to something and say, this is how we're supposed to do it. Instead, I think we should all see ourselves as practitioners in the pre-antibiotic stage of medicine. There will be a lot of examples of things that people have done. Some things will have worked. Some things will have made the patient worse. Some things will have not done anything and we had to try something else. And a good practitioner will be aware of those things in their specialty area. And if not able to avoid new types of mistakes, will at least be able to avoid making the same kinds of mistakes that's been made in the past. And I think this is a really important point, which is that after the global financial crisis, when we started doing our work at the Yale program on financial stability, some of the feedback we got from people was, well, okay, maybe you can analyze things that were challenges in past crises, but the next crisis will be different. And the things that we will need to fight the next crisis will be different. Well, the COVID-19 pandemic is presenting us with a crisis origin that could not be more different from the global financial crisis. It is very, very different. Nevertheless, the Federal Reserve, for example, pulled out the same types of responses that they had in 2008 very effectively, and avoided some of the mistakes they had made in 2008 because they knew what they were doing then, and kind of pulled things together really, really quickly, and stood up programs that I think we can say already were quite effective at dealing with phase one, the liquidity run part of this crisis. So I think it is clear that no matter how things look different in the past, there's a lot we can learn, particularly in certain types of programs that really aren't that different if something is coming from a pandemic or coming from a housing collapse.
Thank you. We have a few minutes left, so I'm going to bunch them because there are many more questions, and hopefully we can get to them in another round maybe. But let me bunch the set of questions together in two buckets. One, capital markets. Obviously, it to some extent was a source of the stress we have seen now. There has been a lot of growth in the capital markets, sometimes to new firms, maybe more risky. Is that a risk still going forward, that we can see some hiccups there? But also, can capital markets be a solution? Maybe securitization, maybe fintech, maybe new forms that can complement, because we talked a lot about the banks. So that's a set of questions. And the second set of questions is quite different. It's about Macroprudential. Have we learned lessons here, how we should have done it better beforehand? I presume so, including maybe on stress tests. Could we have done stress tests better? But also now, what do we do going forward? Can we really release all these macroprudential tools to the degree we're hoping for? So those two big set of questions.
Thank you. Thank you. And first, let me say one thing, which is I've seen a couple questions come across the chat from people who missed part of this, or we will post this video. The whole video will get posted on our website along with the slides. So we'll have that up at some point today if anybody wants to go back and take a look. So once again, Stein, you've done a good job of summarizing some really important questions. First, let me talk about capital markets. So we have talked a lot about the banks. In the United States and the United Kingdom, where there's a very significant capital markets component to industrial finance, it's been very important that they include non-bank lenders in their programs, and they've done so. Of course, the challenge here, and what we discover at times of crisis, is that the relationships and the plumbing that exists that connects government authorities with the traditional banking system is ready-made for helping to get relief into the hands of individuals and businesses quickly. So while capital markets or fintech could be part of solutions in some places, it seems unlikely that out of nowhere they would be able to be part of solving these problems. If the banking system were the primary way that your businesses were financed prior to the crisis, then that's going to have to be the primary mechanism by which we help ultimately in the recovery phase, I think. So that's what I would say about capital markets. On Macroprudential, I think it's a terrific question. We really won't know what worked or what didn't work until we have a chance to do a postmortem from this crisis. I think we're going to be making stuff up as we go along throughout there, and able to rely on nothing more than just like what we read about doctors dealing with the novel coronavirus, trying all kinds of things that might work. I think we're going to do the same stuff with regards to our various macroprudential tools in this crisis. But there will be a phase 5. So we've talked about phase 4 recovery. Phase 5 will be reform. And no doubt we will have some window, depending on your political system, there will be some window to look at reforming the things that we did after 2000, the global financial crisis, and taking the lessons of this crisis and figuring out what we can do better next time. And I hope everyone in this community will join us at the YPFS, and we're going to be trying to think about that as soon as the drinking from the fire hose aspect of the pandemic quiets down, because I do believe one main lesson I took from working on Dodd-Frank in the United States was that, gee, I wish I had thought a lot more about this before I showed up in Washington and there was a piece of legislation already circulating. So I think it would be very useful for those of us well before it's time for your lawmakers to write new rules, and well before it's time for the folks who meet in Basel to construct new international standards. For those of us in the research community and in the policymaking community who are on the front lines, to think about these things in advance and to try to have some principles and some guidance for what we've learned from the crisis. This will be an ongoing activity.
Well, thank you very much. That's a good point to close on. Surely we have already gotten quite a lot of lessons from you now, and so appreciate it very much. We had more than 500 people on the webinar, so that's already a sign of success, but we need to do more, and thanks to all your effort at the center, we're really grateful for that, and we're grateful for you hosting this webinar. So on behalf of everybody, we can't applaud you, but we want to thank you very much for this wonderful seminar. Thanks,
Thank
Andrew.
you very much, Stein. Thank you for this opportunity.
No, thank you. Bye-bye.
Bye-bye.